So do you see my screen?
Yes, I can see your screen.
Okay.
And we are on the air. And there are 5 people. Very nice. Good evening, everyone. This is lecture 3 of Sota for Academia. Thank you for coming. People are joining. Okay, so today we have Peter Haagensen. Sorry if I mispronounce your name. We have Peter Haagensen, a former managing director at Deutsche Bank. I'm sharing my screen. Oop. Okay, guys, who listens, is everything fine with the picture and the microphone, with the sound? Please send me a plus in the chat if everything is fine. Seems to be fine. Okay, Peter, thank you for coming. Thank you for coming. So the stage is yours. The stage is yours. Everything is shared. We can see you. We can see your presentation. Everything is fine. Yeah, so maybe you briefly introduce yourself and tell us how to gain some money with mathematics that we learn hardly.
Okay. All right. So thank you very much for having me. It's a pleasure to be here. And I will talk about a couple of different things. This talk, there's a lot to cover. And it's basically split into 2 parts based on conversations that I had with Sasha in the past relating to how an investment bank works. An investment bank is a really peculiar creature, and it has many different aspects and activities. And it's a bit of a mystery unless you've worked closely with it or inside one. And so one of the things I wanted to cover is how an investment bank works, and in particular, because this is where we're aiming for in the second part, is the trading activities inside the investment bank, which is only one part of what an investment bank does. And so I will be talking about this for maybe the first half or a little bit less than the first half of the presentation today. I am happy to take questions depending on how the format works. I can't hear anybody's voice other than Sasha's. So, but Sasha, certainly if you want to
sorry,
ask questions,
sorry, Peter.
Free.
Forgot to tell, we have live chat. So if anyone has a question, I will read it to you.
Okay, perfect, perfect. The second part of the talk is there on the screen also. It's trading strategies for the mathematically oriented, and by that, basically what I mean is options in it's trading strategies with options. And in order to get to that, then what I will try to do is from first principles, try to understand what options are and how that gets translated into a pricing framework for them. And at this point, this will probably get a little bit more mathematical, but at the end of it, then I have more of an open discussion and just thoughts on how to trade on the back of that. Now, it's not to say that in order to trade options, you have to have an advanced degree in mathematics, but it's good to understand, to have a little bit of an understanding of mathematics, to at least see where this whole thing comes from and understand the limitations of pricing and so on. So without further ado, let me just do a very brief intro on who I am and where I'm coming from in all this. So I'm originally from academia. I'm from Brazil. I went to university in Brazil and I studied physics. And then I went to live after university. I went to live in the US to get my PhD, which I did. And then after that, I had a couple of jobs as a research scientist in physics and elementary particle physics and string theory at a couple of different places. in Europe and in the US. And then after that, I sort of repotted and just completely changed things around in my career, and I gave up academia and went to work in a bank. Initially, not really knowing what I was getting into. It's certainly a very tricky transition when you're in it. Looking back on it now, I think it was really a very good decision.
Good decision. Okay, you don't regret.
Yeah, very much so, very much so. And I think this idea of, as I'm calling it, repotting, which is changing a plant from one vase to a bigger vase, is something that is worth a talk in and of itself.
Yeah.
But that can get very very philosophical very quickly, and I won't dwell on that. But suffice it to say that then I did go into banking, and I stayed there for about 25 years. And at the end of that, I then decided I sort of had enough, and this is where I am at now is a sort of another repotting, but a step towards retirement, which is just trading for myself. And so I've left the bank. I kind of had enough of having a boss and having to do other people's projects, and I just wanted to do my own projects and work on things that I wanted to, that were my priorities. And so this is where I am now, and that's what connects to the second part of this talk, which is trading options. So let's first start with how an investment bank works. And so let me move on. There we go. So first of all, what is the purpose of an investment bank? And I think there's misconceptions about what happens inside an investment bank. And this was certainly, when I first joined a bank, this was certainly a misconception that I had, which is that an investment bank, people are in there and they are taking big bets in the markets, and they're very smart, and they're making money from these big bets. And this is really not what happens inside an investment bank. The investment bank has several different divisions. It does a myriad of different things, vastly different things. It has people with vastly different skill sets doing different activities, one of which is trading, but in a different context from just taking risk. And the way we can sort of unify what happens inside an investment bank in a very succinct way, which covers all of these different activities, is what I have at the top there. The purpose that a bank serves is one of financial intermediation and capital transformation. And at the very high level, it connects those agents who need capital, who typically are companies and governments, to those who have it to deploy, which are generally investors. Now, that happens in many different forms, but the purpose of a bank is to sit in the middle. And even though these are high-level terms, this is really the day in and out activity of a bank, and it's to transform you as an investor have a certain capital to deploy. It's not necessarily in the same form as the capital that someone who needs to consume that capital needs it. And the bank sits in the middle to A, find the sources of capital, B, find the places to deploy it, and C, transform that capital so that it is convenient both to the person, to the agent who has the capital to deploy, and the agent who needs the capital.
Right? And what do you mean? Sorry, if you don't mind if I interrupt you from time to time with my questions. Yes. Yeah. So what do you mean by form of the capital? Okay. Right. Duration, risk, I don't know, currency.
So there are a lot of things, and maybe I think I can answer that question by going through the next step. So the next 3 bullet points really relate to the high level basic activities one main way that a bank does this capital transformation is in capital formation. So it helps companies raise money both at different levels of the capital structure, and so primarily through issuing stock, and that is typically through either primary or secondary offerings, so IPOs or secondary market offerings of shares, and through bond issuance. And so that corresponds to what's called in banking either equity capital markets or debt capital markets. And the process then of issuing a bond, so a company wants to raise money, and it can raise money in many different ways, but two very basic important ways: that is raising money through equity or raising money through debt. That is what the activity of within the investment bank, what is called, maybe confusingly called investment banking within the investment bank. That's one of the main activities that part of the bank does. So it's, you have a debt issuance of, let's say, $1 billion for a company. The bank then organizes how this capital is raised. It lines up investors who are interested in taking risks to that credit. It organizes the legal terms, contractual terms of this bond, in this case, are so that it is convenient and it is to the liking of what the investors are looking for, and at the same time serves the purpose in terms of the size, in terms of the maturity, in terms of the coupon payable for the company who's raising the debt, right? The investment bank can also enable large projects, business expansion. So that has to do with financing, that has to do with loans, that has to do with security on assets that companies already have. And so you may have a company that wants to build highways in a certain country, and that company would then approach a bank, and the bank would do what we call the project finance. It would again organize the debt, the financing in such a way that it gives comfort to the investors that this is in the best shape possible to protect their investments, and at the same time provides the capital that the company needs. Right. So capital formation in that sense is then the activity of the investment banking division within the investment bank. Okay. Ancillary to that is at the third bullet point, which is advisory services. So banks will also have teams of people who can go to companies and advise them on, for instance, mergers and acquisitions. That's one big thing, right? So one company wants to buy another. One company wants to go private and buy its own shares in the market. That type of advisory work is typically also associated with the investment banking division within the investment bank. So, solutions that have to do with saving taxes, with raising finance in the cheapest way possible in the markets that are most convenient, and so on. All of that is the activity of the investment banking division. And then in the second bullet point, that is more the realm of the trading and sales division, which is providing liquidity in financial markets. And this is where we're starting to come now to the part of the investment bank that in the public imagination is what the bank does, which is a bunch of traders sitting there operating in financial markets, right? And so let's delve a little bit into that. And here is also a capital transformation in a sense, to the extent that it is providing liquidity in financial markets. And this concept of providing liquidity is a very deep one in all trading activities, even when you are like me, just trading from home on your own. But that provision of liquidity is something that you get compensated for. So let me move now.
So is it, sorry? So
Sorry?
you said provision of liquidity, yeah? So is it the only goal of bank in trading, market trading? Or?
No, so there are nuances and subtleties to it, but basically this is a very important one. And so in fact, before I get to this, let me stay here one more second. So normally a trading desk will not be just punting in the markets and taking bets. I think the euro is going to go up, and I think Microsoft is going to go down, and I'm going to put a bet on this. I think interest rates are going to go up, and so on. That is manifestly not happening in an investment bank. And I have a specific slide that deals exactly with that. So let me hold that thought for now. And we'll go a little bit more into what the trading activity is inside the bank a little bit further down. So
does bank make any money with market trading?
What's that?
Does bank make any money? What's the percentage of profit, if any, do they have?
So that is a very crucial question, and thank you for asking it. Because
I like such questions.
The bank, the purpose of the trading desk is manifestly not to make money through taking positions, like it is the job of myself as a trader trading from home to make money. Obviously, I'm going out in the market, I'm taking positions, and I'm hoping that the positions I go long will go up and the positions that I go short will go down, right? And that's how I make a living. That is not what is primarily happening at a trading desk in a bank. And we're going to get to that. So I promise it's in the next slide. Just hold that thought. Okay. But a bank is not, and I repeat, this is very important. A bank is not just punting around, taking positions to make money on open risk. A bank is, when it trades, it does not take risks. Now, take that with a pinch of salt, because markets are big and imperfect and sometimes illiquid. So, but hold that thought. We're going to get to this. So let's now, from an organizational point of view, look at what the different divisions in the bank are. And very broadly speaking, you have what's called front office, middle office, back office, and the C-suite. So the C-suite is the CEO, the CFO primarily, and you may have the CIO and the CAO and the COO, but primarily the function of the C-suite is to deliver the vision, the strategy for the bank, to manage all the different functions, to interact with the external counterparties that we're going to see who they are in a second. And then front office are the revenue generators. So these are the investment bankers, these are the traders and the salespeople and the structurers. These are the people with direct client interaction. Middle office is responsible for the reporting, for the controls, both from a regulatory perspective as well as from a risk perspective. It controls the P&L of the bank, so the profit and loss accounts and all the finances of the bank. That is also controlled by middle office. And then back office is all the piping. So it's all the operations and the technology that greases the machine and makes this all work. Okay. Now, so focusing a little bit more now on what the front office does. So as I alluded to before, basically there are two, and you may find more, and these things are cut across different, slightly different ways depending on which bank you're talking about. But basically, you're talking about two most important divisions. One is the investment banking division, and one is sales and trading, also called the markets division. And in the investment banking division, as I was alluding to before, and those are the guys, those are what we informally call the suits. You can tell the difference between someone in the investment banking division and someone in sales and trading. Because in the investment banking division, everybody dresses with a suit and a tie and very sharply. And in sales and trading, not so much in sales, but certainly in trading, people dress in torn jeans and t-shirts, and so the investment banking division are the suits, and those guys are called investment bankers. Now, even though everybody works for, again, the nomenclature is a little bit confusing, but everybody works for an investment bank as an entity. You have the investment banking division inside that, which does all the capital markets transactions, the bond issuance and the equity issuances, and the advisory services and mergers and acquisitions, and ECM and DCM and so on. Those guys are called the investment bankers. So a trader is not an investment banker, even though the trader will also work for an investment bank. But it's in the investment banking division where you find what you normally call the investment bankers. And then in sales and trading, you have primarily three functions. You have sales, you have trading, and you have structuring. Structurers are a function that are may seem a bit mysterious to the outside world. They're very important. A bank cannot function without them, or certainly a sales and trading division cannot function without them. They are sort of a little bit the glue that links sales and trading. So the trading guys are usually these guys who sit in front of a screen the whole day. They don't like to talk to clients. They come and do their job, and they're looking at screens, and they're typically the more quantity types, and they are operating directly in the markets. The salespeople are the guys who talk to the clients and see what the clients need. They need swaps, they need equities, they need FX, they need a whole bunch of different asset classes and trades. And then they talk to the clients, and then these guys come and talk to the traders. They don't, if you're speaking very loosely, they don't quite, this is an exaggeration, but just to give a little bit of perspective here, they don't quite talk the same language. And the structures, you can sort of see them as the guys who can talk shop with the traders and at the same time understand what the clients and the salespeople are trying to convey. So the structurers will go to the client meetings, and the client says, I want this or that. I don't know exactly which form it has to take, but I need this. And then the structurer is the person who can then put together a financial product that says this does exactly what this guy wants. And then he or she goes to the traders and says, look, I figured out this, I dreamt up this trade. I think this trade is really good for this client. Do you think we can do it? And then the trader will look at it, and the trader will look at the risks, will look at the liquidity. The trader is the risk taker, and the trader will say, yeah, but I can't offer this product. You're asking me for a 40-year swap. There's no liquidity in this market. I can't do that. So you may have dreamed up this amazing trade for the client, but the market just doesn't support it, right? So that's more or less taking a more detailed look within the sales and trading division. And the sales and trading division then deals with these different asset classes that I have there, which is fixed income, which is primarily interest rates and credit, and then equities, foreign exchange, and commodities. So that sort of describes the different functional parts of the bank. And now you have an external ecosystem where this bank lives. And it lives in an ecosystem which has clients, which has clearinghouses, regulators, and competitors. And I may have forgotten other parts, but these are the primary people you're dealing with. So regulators are normally agencies related to government. They can be a Ministry of Finance. They can be like an SEC, the Securities Commission. They generally come in. They have the right to come in and look at all the books of the bank and see, what are you doing here? What are you doing there? Why are you doing this? And so on. The regulator basically has access to come into the bank, install themselves in a room and say, give me all your trades or your dealings, and we want to sit here and look at all this. And the regulator then determines if the bank is doing everything right or if it's violating any type of rules in any way. The competitors are, needless to say, are other investment banks, and you know, they do the same thing, and they're competitors.
What was your role?
Sorry?
Did you wear a suit in the bank?
No,
no.
I'm not an investment banker. No, I'm a trader. So I worked in trading.
Okay, got it. And regarding the regulators and regulations, is it law? What do they check? What's the interest of the state in controlling the bank?
So there are several different parts to the regulator. One very important one has to do with the maintenance of capital controls. So a regulator, so in the US, typically you have your regulator will be the Securities and Exchange Commission, the SEC, but you have other ones as well. You have the FDIC, you have the OCC, which is the Officer of the Controller of the Currency, you have FINRA, you have a number of regulators, and they will come in and look at the books and say, is the bank holding enough capital for the risk that it takes? The primary risk that a bank takes has to do, well, the primary financial risk, the bank takes many different risks, but the primary risk that the bank takes is counterparty risk. So that's the risk that you're in financial dealings with clients who may or may not perform according to the contracts that they've entered into. The bank assumes that they do, but the bank needs to hold capital against a missed performance of a counterparty. If the bank, to the extent that the bank takes outright market risk in its dealings, then they must hold capital against that as well. The bank also has operational risk. It's the risk that basically at some point computers will fail or other things can happen from the plumbing perspective. And you have to continue to service contracts when your machines are down, for instance, right? That's operational. There's operational risk measurements. The regulator will come in and say, you are taking an adequate amount of risk. We are comfortable that you have enough capital held back for the amount of risk that you're taking. So that is one important regulator. But there are also regulations with regard to law, with regards to money laundering, with regards to corruption, with regards to all sorts of shady dealings that either clients or the bank itself may be subject to. And so that's a different type of regulator that normally has to do with compliance. And the bank also needs to satisfy that. And these regulators are typically governmental organizations that have every right to come into the bank. There's no confidentiality with the regulator. The regulator can come in and say, I want to see this, and you have to open up all your books. to the regulator. A bank is normally regulated by different regulators. So if you have a bank that's an American bank but has European operations, then the bank may be regulated by the ECB, may be regulated by these regulators in the US. It will be regulated wherever it is operating. If the bank opens a subsidiary in Spain, certainly the Bank of Spain, which is a central bank in Spain, will have a say in how the bank performs according to its regulations, and over and above the regulations that it must subscribe to in the US, in Europe, and everywhere else, it will have to subscribe to the local regulations in Spain, which the Bank of Spain will enforce.
Got it.
So banks are subject to regulators everywhere they are.
Peter, maybe we can speed up a little. It's half an hour already past.
Okay. Okay. Right. So let's move on. So here, this diagram is just, and I can go quickly through this because it is just a little bit more detail on something I've mentioned before, which is this transformation of capital. Right. So you have on the left-hand side these agents or market players that have capital to deploy. That's institutional investors, it's typically hedge funds, pension funds, high net worth individuals, insurance companies. They have capital to deploy, to put to work. And on the right-hand side, you have agents who consume capital. So corporations, governments, infrastructure projects. And the bank sits in the middle and transforms the capital from the shape it is on the left to the shape it needs to be on the right. Okay? Now, here is the part that exemplifies, that shows, hopefully in a clearer way, what is happening in the interplay, particularly within sales and trading, or particularly within trading in the bank, the interplay between these different agents. And so the way I like to put it is if you draw a circle in the center where all the banks are trading with entities outside. And so obviously this is very schematic, but you have corporates, insurance companies, pension funds, hedge funds, and so on, governments, right? And by the arrows here, I mean financial contracts that they enter into. So these are trades. And I put an arrow going one way or another for a reason you're going to see in a second. But basically, when you enter into a financial contract with someone, you enter into a type of financial risk, and your counterparty has entered into exactly the opposite financial risk. It typically is a zero-sum game as far as that trade in isolation is concerned. If trade makes money for counterparty A, it loses money for counterparty B, and if it loses money for counterparty A, then it makes money for counterparty B. And so the risk flows in one direction or another. Now, the banks sit there in the middle, offering liquidity. So these guys on the outside, the corporates and the pension funds and so on, they are coming in and requesting, I need some euro dollar, or I need to do an interest rate swap in whatever currency for however long. The bank provides liquidity. So the bank will say, okay, I will give you that trade. I will stand as a counterparty to you on that trade, so that you put on the risk that you want, and I will take the opposite side of this risk. And the bank may not know that it can immediately find the offset to that risk. But that trader's job is to immediately cancel that risk. So that trader, if one counterparty wanted to buy 3 billion euros, sell dollars, then the bank has gone into a very large risk position the other way around. He sold euros and bought dollars, and he needs to get rid of that position. So he is not in the business of taking outright positions to make money because he thinks that euro dollar is going to go up or down. That is not their job, right? So their job is to actually go to another bank and find the opposite side of that trade, or maybe even go to another client who he knows wants the other side of that trade and take the other side of that trade. But a trader wants to get out of all risk. Where does he make money? He makes money from commissions.
From commissions.
He's going to trade at a different level with one client than he is where he does the hedge on the other side. And typically the way it works is that he knows where he's going to have to, where he can buy the opposite risk, and he will charge the client that amount plus a certain fee. And that fee is the money that the trader makes. And now if euro dollar goes up or down, that trader doesn't care. It can go up, it can go down. He's hedged, right? And so these guys on the outside, they are what are called end users, and whereas the guys on the inside are called the intermediaries, and they are the ones who are offering liquidity and doing the trades that the guys on the outside are asking them to do. But notice that these guys on the inside, they are looking to trade, to take no trading risk, as opposed to the guys on the outside who are the end users, and they are looking to take specific risks.
Okay.
And those risks may be hedging their businesses, their underlying businesses. But in and of themselves, these trades have open risk, which they want to take. Okay, so
and what
these
if,
guys...
Sorry, what if end users wants to hedge risk?
Yeah,
minimize the risk.
So let's say, a very typical situation, right, is you have a corporate in France who sells products in the US.
Yep.
And so their revenues are in dollars, okay? But they have a euro balance sheet. They have euro liabilities. They need to pay their salaries and all their bills in euros.
Yep.
They have a share which is listed on a European exchange in euros. And so these guys are receiving massive inflows of money from the US in dollars, and they need a hedge to that, right? So now that business that they have, that is dealt with somewhere else, right? They are dealing with clients in the US, and they are receiving those cash flows. They are approaching the bank to say, I'm receiving these dollars, I want to sell the dollars to you, and I want to guarantee a rate at which you will exchange them for euros to me. And then I am now hedged in foreign currency, and I have everything in euros, okay? So it's not that the outside players are actually just taking punts. Sometimes they are, because hedge funds, that is what they're doing. But a lot of times they are hedging something that is not in this diagram, that it's external to that, right? But the important thing is that the guys in the banks sitting in the middle of this circle here, they are looking to take no trading risk. Now, sometimes trading desks do purposely or not purposely take trading risk. They can take trading risk because they weren't able to cover the risk that they took on by offering to make a market, or they can take trading risk because they legged into a position and they think that the market is going to go in their direction, and so they make some proprietary P&L. So they make some profits out of a view that they take, but they will have very strict limits on how much they can keep open positions to take any outright risk. So it's important to know, and a common way to describe these players are also that the external players are price takers, and the internal players are price makers. It's the guys on the outside who come and make the phone call to the guys on the inside and say, I want to buy some stock of Taiwan Semi. And so that guy is a price taker. The price maker will tell him, I will sell you this for X. Okay. So, all right. So that's that. Now, that kind of does it. We're at 40 minutes. And so that was the first part of the presentation. And I wanted now to go into the second part. So focusing now on trading activity. And now I'm taking this to a broader context, which is not just sitting inside a trading desk in a bank, although a lot of what I'm saying here obviously applies to that. But I'm generally talking about the activity of trading, and in particular trading in stocks and in options. And for that, I want to now sort of step outside of this complicated world of the investment bank, but really just look in isolation at someone who is sitting at a desk and working for his own account. So without any regulatory constraints, any objectives coming from the bank or the desk that he or she works for, but just pure trading. So that person, that isolates the trading activity and takes away this complicated context of what's happening with clients and their internal control functions and so on, but really just trading. And the trading that I want to focus on is the trading that is, as I say here, for the mathematically oriented. This has to do with trading options. So obviously there's trading in all sorts of things, all sorts of different asset classes and different types of instruments. But now I want to really zoom in on trading in options. And to do that, let me just start with what we call Delta One. And Delta One is just this. I like Google. And so I'm just talking about equities for now, right? And this is the price history of Google over the last year or so. And I've done some analysis on Google, and I think it's a good company to buy at this price level. So I go and I buy some shares, but then the stock goes down and I lose some money, and then I sell and I buy and I sell, and the news flow tells me that it's going up and it's going down and so on. And this is what we generally call Delta One. I buy 100 shares of Google. It's trading at $178, and I have a portfolio which is worth $17,800.
Yep.
And now I can do a bunch of things. Stock goes up and I sell a little bit, or I buy even more because the stock is going to go up more, and so on. And that's a lot what a lot of people do day trading.
So what is Delta One exactly? Is it a number or?
So no, so Delta One, Delta One as opposed to trading options. Delta One means just taking a position in the underlying stock, and it's Delta One. One refers to 100%.
Okay.
And it means that you are taking 100% risk of that stock. It sounds a little bit like a tautology when you look at it just like this in and of itself, but it's just that because when you trade options, you trade positions which are a delta of less than one or more than one. And so that differentiates them from just buying the underlying. Delta One in this graph here, so this graph is your P&L, right? You start at some point, your P&L is zero, and you've bought some stock, you've bought these 100 shares, and if the stock goes up, that's your P&L going up, and if the stock goes down to the left, that's your P&L going down. Now the slope of that line is 1. That is Delta One.
Okay, got it.
Is basically if you look at your payout profile, given whatever contracts you have, very generally speaking, right? So the tangent of that payout profile at whatever price point, that is your delta. And in the case of just owning one share of anything, your delta, no matter where the price goes, it can go up, it can go down, it can do nothing, your delta is 1. That is the slope of that curve. And that curve happens to be a straight line with a slope of 1 throughout all the different prices.
Clear.
Right. So that's why we normally refer to this as Delta One, because it's a sort of a prelude to talk about options. So now we say, okay, why do we trade options? So before we get to that question, we need to ask, what exactly is an option? And so there are many different types of options, and I'm going to deal here just with a the very basic building blocks of options, which are what are called European call and put options.
Mm-hmm.
And those contracts say the following. There's a buyer and there is a seller. And the buyer enters into a contract which for a certain amount of time, it can be a week, it can be a month, it can be 3 years. It's a certain amount of time, but it's contractual. So it's predefined at the moment you sign this contract. So let's say it's 6 months to be specific. So for the next 6 months, the guy who buys the option has the right, but not the obligation, to buy a certain amount of shares at a predetermined price. So let's take the example of Google, which is trading at $178 a share. And I want to enter into a contract with someone where I have the right to buy a share of Google at $178 from now until 6 months from now. So until April next year, right? Whatever happens to the share of Google, I can make that phone call and call the seller and say, hey, I want to buy those shares of Google. Remember, we entered into that contract? I'm going to buy those shares of Google at 178. Now, obviously, I'm only going to do that if the shares of Google are higher than 178. Because if they are lower, then I'm just going to buy the shares in the market.
Yep.
And so that contract where you have the right but not the obligation to perform a certain transaction, then gives you a payout profile which is only positive. You can only have upside from this, right? Because if the share has tanked and you have the right to buy the share at a certain price, then you just won't exercise it. You let the contract expire and nothing happens. Whereas if the share price has gone up to 200, and here you have the right to buy some shares at 178, well, you've just made $22 per share, right? Because you buy those shares at 178, you sell them in the market for 200, and you've made $22 per share.
It sounds like an insurance buying, yes?
It's in some sense, yes, but it has something more continuous about it than an insurance contract, right? Which depends on sometimes on very binary events like your house burning down or something like that. A put option is a contract that gives the buyer the right but not the obligation to sell a certain amount of shares at a price at a predetermined price. So again, if I think that Google shares are going down and I own some Google shares, I want to make sure that I can sell those shares at least for 178, which is where they're trading today, right? And so I buy this contract from someone that says for the next 6 months until April, you can you can sell the shares of Google at 178 no matter where the market is. So along the way, shares of Google go up to 200. Well, I'm not going to do anything. I'm just going to let it expire because I don't want to sell it at 178. I'll sell it at 200. But if it goes down to 150, then I'm going to exercise my right to sell it at 178, right? And I make money with that.
So how much shall you pay for such a privilege?
That's right. So let's get to that. That's in the next slide. But you can already tell, you get a flavor of if you want to calculate the value of this option, and I'm calling this C in this case for call option, right? It depends on where the stock price is, that's S of T. It depends on K, which is called the strike, which is what is this predetermined price. It depends on T, the total maturity. Obviously, if I have an option for a whole year, it's worth a lot more than an option for just a month.
Yeah.
It depends on the time today. And it will also depend on two other variables. One, which is the risk-free rate, or the rate at which I can invest my money in a bank account without any risk. And it depends on something called the implied volatility, which I will ask you to hold the thought on that for a second. I'm just trying to be precise in my language, but I don't want to go into what these things mean. But suffice it to say that implied volatility is very closely related to the volatility of the underlying. But hold that thought for now, because it's not exactly that, but it's very similar to that. So now, here we go. I've just bought an option, a call option, and this is my payout now, right? So if the option here, I have the right to buy the share at 4% above the price today. So let's say that's going to be like $190 for Google. I have the right in the future to buy it at $190. And so I have a payout which to the right goes up and to the left is just worthless. I don't use the contract, right? Consequently, and here's where the zero-sum game is, the person who sold me that option has that profile.
Yep.
Right. So that person has exactly the opposite. If I made $15 on this contract, the other person lost $15. That's as simple as that, right? Accordingly, if it's a put option, then I will have this profile, and then the person who sold me the option will have exactly the opposite profile. Okay. So now, you may say, now I'm getting to the question which you've just asked, right? I've superimposed here in orange this profile of the call option, and in blue just the profile of holding the share, the underlying share. Now clearly my payout is better, has no downside if I just hold the option, right?
Yeah.
So why would I not always be trading options instead of the underlying? And here are a couple of reasons. One, you can hold a share forever. An option expires after final payout at the end of its contract. So even though with an option, you're also taking some form of risk, long or short, to an underlying, at some point, that contract will come to an end. And so that payout, it happens and then it dies and the contract is expired. Here is a very important one also. If the share price stays the same, you can sell the share later and recover the same money you spent. You don't lose any money.
Yep.
For an option, if the share price doesn't change, the option expires worthless. You pay a premium for an option, and once the option expires, you get whatever payout we were supposed to get, but the premium is not refundable and it vanishes. That is what we call, and this is a very important concept, I cannot overemphasize this, that is the time value of options, and which is also known as theta. Okay. So there you see, like you alluded to before, when I buy an option, I'm spending a premium, so I'm spending some money. So, and if nothing happens, that money will have been wasted. So that's why people may or may not want to buy options, right? What are possible rationales to buy options? One is you get the positive performance when the underlying moves without any downside, right? So you're protected. So I want to get exposure to the S&P, and I think the S&P is going to go up, but I'm not so sure. I certainly don't want to lose money if the S&P goes down. And I figure I can spend some money on like an insurance, which says if the S&P goes down, the worst that's going to happen is that I lose my premium. But everybody else around me is losing money left, right, and center because they've invested in the S&P, and I, luckily enough, just bought options. But if if S&P goes up, then I participate in the same way as I did, as the person who just bought the S&P did, right? So you get positive performance, and you're willing to pay a premium for that.
So what's just to have a grasp of what it is? If I buy $10,000 worth of S&P for 1 year, and I want to hedge it with an option for 1 year, how much will it take approximately? Will it be 1,000? Will it be $100?
Okay, so that's an interesting question. Let me give you some numbers just to give you a little bit of perspective on what this cost is. So
it must be, sorry, just from thoughts from the top of my head, it must be close to expected value of stock price difference, right?
Well,
something like that.
Okay, it actually is, and that's something that I'm not covering explicitly in the math and the heavy math that's coming later, but it is, in strictly formal terms, it is the price of the option is the expected value of this profile. Of this profile is
Of the profile.
flat to the strike and then going up in a straight line,
Yep.
right? If you look at the expected value of that, given the underlying Brownian motion of the underlying stock,
Yeah.
you look at the expected value of that, that is the price of the option.
Okay.
But let me get more real with you here.
Yep.
So typically, if I buy a 1-year option on the S&P, just to give you an idea, again, of something tangible, right? So 1 year, and what we call at the money. At the money means that the strike or the contract price is equal to where the spot is now. So the S&P is, I don't know, some
5,000 or whatever it is.
whatever, 5,000 something, right? So if I buy an at the money call option, okay, for a year on the S&P, that is very much very closely related to what I was referring to before as the implied volatility of the option. And the S&P right now has what is considered very low volatility, which is low implied volatility, which is about 16%. So you can have implied volatilities on, for instance, smaller or high-tech companies. You can have implied volatilities of 60, 70%, sometimes over 100%. The S&P is just about the lowest implied vol you can find anywhere in the market. And that right now is about 16%. Something that is up to, Google, you'll find is like high 20s. It's not super volatile, but it's definitely more volatile than the S&P. And if Microsoft is probably a little bit less, is maybe in the mid 20s, but Meta or Facebook will be like in the high 30s. So obviously it depends very much on what the company is. But let's get to specific numbers.
Okay.
So for the S&P at an implied vol of about 15, 17%, you're going to pay for a 1-year option somewhere around, or at the money call option, you're going to pay somewhere around 11, 12% of the price of the underlying.
It's quite a lot. But that's logical. It must, your expected value must be zero anyway, right? Because no one wants to take risk. The option seller also doesn't want to take risk.
That's right. It has to be, in a sense, for this market to function, right? That price has to be the expected value of this payout.
Yep.
Because otherwise no one would get into the other side of the contract.
Exactly.
If it was either more or less, you would get into the other side and eliminate the arbitrage.
So in terms of probability theory, right? You're shifting your distribution to zero, and only taking the forgot in English words by the end of the day. You're buying it for the expected value for mu, right? And you're only taking the deviation.
You're buying it for the expected value of the upside. It's not the expected value of the share. It's the expected value
of the upside. Right. And you only take risk of the deviation.
Yes.
Okay.
So now that is not to say that you have to buy 1-year options. So there's a lot of time value in 1 year. If you're buying, and normally the value of the option grows with the square root of the time. And so between an option that's a year, the price will basically be 1.4, right? You just square root of 2. Okay. So that is to say you can buy shorter term options, 3-month options, 6-month options in low vol names where you're going to pay maybe
few
4%, 5%. Yeah. So it is possible. So that becomes a question of what view do you have on the underlying price? What is your risk tolerance for downside? What other investments and trades you have outside of the one you're looking to do? So that is a question that takes me actually to the very last slide in the presentation, which has to do with measuring and understanding your own risk tolerance. Okay, and for all I know, you may be buying this because you want to hedge, just hedge your position.
Yeah. What are the cases? Why would I want to buy except hedging? Hedging is obvious.
No, so one is you want to take exposure, right? So
Mhm.
so let's say I want to have exposure to 100,000 of the S&P.
Mhm.
Now I can take $100,000 from my bank account and I buy S&P shares.
Yeah.
Okay. And I'm going to buy however many shares that affords me. So that costs me $100,000. But I can take $11,000, which is let's assume it's 11% for a 1-year option. I can take $11,000, spend on that option. If I have a very high conviction that the S&P is going to go up, right? I spend the $11,000, and I get the performance of $100,000. I get 9x the performance, right? So you get a tremendous amount of leverage because you get the performance as if you held the underlying, but
Sorry.
you're only paying the option premium.
Yeah, once again, please. So one option is to buy S&P for $100,000. Another option is to buy an option for $11,000. So it gives you the right, the right to. So how do I make more money with that option?
Well, I mean,
what's the mechanics? I buy and then the S&P, right? Yeah, could you explain that in layman's terms?
So if you're buying, you're saying what's the mechanics if you buy the option?
Yeah. How do I get? So if I buy $100,000 stock, yes, and I sell, and let's say it grows by 5%, I will get $5,000, right?
Yeah. Let's take. Can we take like a hypothetical example to make real numbers onto it, right?
Yeah.
So let's say that the share costs $200.
Yeah.
Right. And so $200. If I buy 50 shares, if I got the right number of zeros there, then that's 100,000, right?
Yeah. Seems correct. Yeah.
So if I'm buying 50 shares at
2,000 each.
2,000? Oh no, 500 shares, right? Sorry. Yeah. So if I'm buying 2,000 shares at $50. Sorry. Let me write this down in a second. So we have $100,000 investment, right? And each share costs 200. Then I am buying 500 shares at $200. That's 100,000. Okay. So 500 shares. So I bought 500 shares, and if the share increases by, let's say, 20%, right, then I'm going to make 20% of 100,000. I made 120,000.
Yeah.
And so my P&L is 20,000.
Yep.
Right.
Clear.
Equivalently, so that's the guy who's just trading Delta One. I'm trading options, and I say I'm going to buy a contract for the same number of shares, for the same 500 shares, and this contract is going to cost me 11,000. Okay.
Okay.
And my payout at the end of the contract will be the same $20,000. Right? That's the P&L, the difference between 100 and 120. Because your option contract is for the same number of shares, right? You have an option on 500 shares. Okay, so the P&L is 20,000. So you spent 11,000 and you made 20,000, right? So that's a return of over 100%. So the Delta 1 guy, he made 20%. The options trader made almost 100%, right? Because he invested 11 and he got back 20.
Oh, okay. Okay. Got it. Yeah, we have a question in the chat from Andrew. Do you mostly trade options or underlying stocks?
So I trade both, but if we have the time, we may be running out of time because we're at an hour now. But there's a very compelling reason that actually some people should just trade options. But let me not dwell too much on that. I think normally what people do is trade both options and the underlying. Sasha, let me move a little bit quicker because I realize we're at an hour now.
Yeah, sure.
I have a lot of math to go through, which
interesting talk anyway. Yeah.
I'll be happy to go through, but if you want me to skip it, then we can. Okay. So now the next problem we have is we have a final profile, right? Which is this what we call a hockey stick.
Yep.
Right? This flats to a certain point and then a straight line. And that profile, that's the profile at expiry. That's going to be your payout as a function of the underlying stock. And so that is very succinctly described as max of S minus K, comma 0, right? If it's positive, is S comma K, S minus K. If it's negative, it's 0.
Yeah.
Right. And the problem statement is this. What is the price of this option before expiry? So that's the price at expiry. What is the price before expiry? That is the entire question. That's it.
Sorry, when do you pay for the option? In the beginning, at the end, or?
No, you pay for the option at the start.
At the start.
You pay up front. Yeah.
Upfront.
You pay up front for the option, right? And at the very end, so this contract has two cash flow points. One, on day one, you pay for the option.
Yes.
And then on the final day, you get this payout. In fact, it's not that you get this payout, you really go through the transaction of buying or selling the option if it's in the money, right? But I'm just mathematically describing it as the profit you make by buying or selling the option at those given prices.
Okay.
Right. And so let me just read from this. So basically you say, what is the value of the option at any time before expiry? Because that's the price that I'm going to have to pay to buy the option or that I'm going to receive if I sell the option, right? Assuming the underlying stock price follows a stochastic process of a geometric Brownian motion. Now, we're going to get into some very heavy maths here. So I can be very high level about it. And if you want, I can dwell more on it, but let me just try to sort of describe it in words, right?
Yeah, let's try.
But what a stochastic process is, normally if you just have this first piece, like ds is equal to mu times dt, then that's just a very simple, in fact, it's a very simple solution, right, for S of t. What we have here in a stochastic process is this term dw. dw is proportional to the square root of dt, of your time increment. And that introduces lots of interesting things. So if you have this increment dw, which is proportional to the square root of dt, and a normal distribution, this epsilon 0, 1, right? It's a normal distribution with mean 0 and standard deviation 1. So that's just a number from this random sample times the square root of dt. Then what you have is what's called the geometric Brownian motion. It doesn't work if it's dt to the power 3/2. It doesn't work if it's dt squared. It doesn't work if it's dt to the power 1/10. It only works if it's a square root of dt. Okay? I'm not going to get into that. It's very complicated.
Okay, but is it experimental knowledge or is it some theoretical model that just fits well?
It has to do with how the process either collapses.
Oh, okay.
So you can define the process whichever way you like, right? I can say ds is proportional to dt to the power 53 if I want. I'm constructing this process. It is what I tell it to be, right? But if it's not exactly the square root of dt added to the linear term to the dt, then either the process will always collapse or the process will always explode. And so they just become useless processes.
Okay.
Right? They are processes which nowhere near describe the reality of the stochastic processes that share prices follow. It also helps that with it being a geometric Brownian motion, then the solution is going to be very elegant, as we will see here. Okay. Now, what we're looking for here is we are looking for this C of S, right? It's some function of the stock price and then some other parameters whose final profile is this, and in between it's worth something else, right? And you can see it's probably like some curve that is similar to this profile, and as time passes it approaches this hockey stick profile, right? But what the solution we're looking for, and we're not saying that there's a unique solution for that, but we are looking for a solution which is very particular. We're looking for a function C, this call option value, whose only stochastic dependence is in the price of the share itself. It itself is a deterministic and non-stochastic function of the share price. The share price is stochastic, but C as a function of X is not stochastic. It's a well-determined function. So let's say you take some function which I build arbitrarily. C is equal to S squared. Certainly, I can define the process for C. It will never end up in a profile like this, right? This is just some random stuff I dreamed up, right? But it is a valid stochastic process. If S follows a geometric Brownian motion, then S squared will follow some other kind of stochastic motion, not geometric Brownian motion, but some other stochastic motion, right? We are looking for a function here which is not a function of the stochastic process of the share itself, other than being a function of that share price. Okay, so C is a non-stochastic function of variables S and T, and then again with all the parameters K and sigma and so on, and it's not an explicit function of the term drift term mu. Why is that important? Well, one reason you may say is that you have a very elegant solution which works really nicely and simulates the stock price as well. But another one is that you don't want your Black-Scholes price, or sorry, let's not get to Black-Scholes, but you don't want your call option price to depend on this drift term, mu, okay? When you say ds over s is mu times dt, that means that apart from the stochastic motion from the dw, right, your stock is growing at a drift of mu. And so you have some companies which have a very high drift, some companies which have a very low drift, some companies may have a negative drift. You want this option price not to be a function of this mu.
Okay.
That is what's called a risk-neutral pricing framework. Okay. It's very important to think of that because, you know, normally if you just go to a textbook and the textbook will just tell you how to derive Black-Scholes and solve the equation and so on, it won't necessarily focus on that, on how are you limiting yourself to find solutions to that. Okay, so once you've defined that, then the rest will become easier. And I'm going to read something here which is going to sound complicated. I won't go into the detailed nitty-gritty math of it, but that will lead via Ito's lemma to a solution, a very elegant solution for C, in that it satisfies the second order partial differential equation in S and T, which is equivalent to a heat diffusion equation, where T is time and S is space, with certain boundary conditions. And the solution to this is the Black-Scholes formula for option prices. So now let's go through it. And I don't I hesitate here to go into, because we are over an hour. I'm just going to describe the steps. The math is less monstrous than it seems, but let me not go into it and just describe the steps.
Yep.
So first, there's some assumptions you make about the model. First, that the stock price does follow geometric Brownian motion. You have a risk-free rate which is constant. You have no dividends in the stocks. You have infinite trading ability, no transaction costs, continuous trading, and no arbitrage. No arbitrage is very, very important. And what you're going to do now, you may. This is point 2 here is the crux of it. Is I'm saying I have this option, which is a mystery to me right now. I'm trying to find a price for it, but I am going to hold what's called a hedging portfolio. I'm going to assume, and then I'll never need to prove whether that was right or not, but I'm going to assume that if I hold a certain amount of underlying shares, those underlying shares, and I'm rebalancing them as prices move up and down, I'm able to reproduce exactly the variability of the price of this call option. And so I'm trying to transform what is a complicated price, which is still a mystery to me, I don't know it, into a very simple portfolio, which is a certain fraction, which by the way is the delta. It's delta, which is not, but it's this delta, a certain amount of shares. And if I assume that the combination of these two things, the call option plus a certain amount of these hedging shares, then that portfolio is entirely deterministic.
Okay.
It's a huge step, right?
Yeah.
You're making a huge assumption. You don't know if that can ever be proved right or not. Okay, but you run with it. So you run with that assumption. If you can find it, then you can see intuitively how you can find that the call option is a price of the underlying share, but does not have an explicit stochastic piece in itself, because I'm just replicating the option with some amount of shares that I'm rebalancing. Okay, and so that's what this step 2 is doing. V is the option, whether it's a put or a call or some kind of option, right? And I'm holding a delta number of shares, and that portfolio of one thing minus the other. If I look at what DS is in the stochastic process, it has a DT piece and it has a stochastic piece DW, and I put this in here. I just do the straightforward maths on this. Okay. And it's just a little Taylor series expansion, but I get that the variability with a little step in time and a little step in the share price for the portfolio works out through this formula here. This is what Ito's lemma is.
Ito's lemma. Okay.
Yeah. And I chose, now maybe at another presentation sometime in the future, I can show how this works. It's not too difficult. It looks scarier than it is.
At the first glance, yes, but yeah.
But it all has to do with the fact that the square, when you do a Taylor expansion in these differentials, you need to take the square piece of the dw, because remember the dw is proportional to the square root of dt. And so there's one piece in the second order expansion which you preserve, unlike a normal Taylor expansion. So, and that will be proportional to dt. So enough said. But then you get this equation here, which has, you see, it has some dt piece and it has some dw piece.
Yeah. I
want to eliminate the dw piece. And so if I do that, and now again, I'm not going to go into the details, but trust me, it's not too difficult to find out. If you add it all together, you get a dt piece multiplied by some equation, you get a dw piece multiplied by something else, okay? And that, let me see, let me go back once. But that dt piece, okay, is what you want to make equal to 0. And so if you take that, and you put it together and you say that, here comes the no arbitrage principle, but this portfolio must earn the risk-free rate. Okay, you put all that together and you get that this dt piece that's multiplying, term multiplying the dt piece must be equal to 0. And that is that equation which you see right there. That is nothing but a heat diffusion equation in some transform variable. So heat diffusion normally is, you have a function that describes how heat propagates from a certain source, from a certain boundary, right? You have temperature as a function of space and as a function of time. And that temperature satisfies an equation which is the second derivative with respect to space is equal to the first derivative with respect to time.
Okay. Is it because sorry, is it because heat diffusion is also related to Brownian motion? Is it the same like source of this?
Interesting. Let me get back to you. I would love to say yes, but
I mean, why would stock pricing have the same equation as
it
heat
could
diffusion?
very well be. I'm sure the answer is going to be yes. I don't want to say something that I'm not 100% sure, but that may well be the case.
Okay.
At any rate, if you transform some of the underlying variables, you get to, and this transformation is well known. In fact, is how you solve the equation. You get
boundary conditions.
This is the second order partial differential equation, which is second order in S, first order in T. Okay. Yep. And now you need to solve that.
Yep.
And the way you solve it obviously is well, not obviously, but to solve a second order PD, you need some final or some initial conditions. Yeah. In this case, there are final conditions. So the system propagates backwards in time, if you want, from a mathematical point of view. And you need some boundary conditions. And the boundary conditions, because this is a one-dimensional spatial problem, boundary conditions are x equals 0 and x equals infinity, x tending towards infinity, right? And so these are the conditions that I'm solving here. Basically, it says that at the final time, the first one, final conditions, final time, the
price will be
the price is equal to that. Yep. That's what we started with.
Yeah.
And then it says that at these 2 points on the boundary, namely stock price equals 0, then both the value of the function and the first derivative of the function are equal to 0.
Okay.
And then at the other end, which is as stock price tends to infinity, then this function tends to, the derivative tends to 1. In other words, C is a function that grows as basically S minus K. Okay. So with these boundary conditions, then this is just very standard math. You need to transform it into the sort of standard variables to make this look like a heat diffusion equation, and then the solution is well known. And the solution, there it is in its full glory. If you transform it now back to these variables that we're using here, now this formula looks very hairy, but it's only got symbols that are very easy to understand. Right? So that's the price of the call, that's the price of the put. All these symbols here are stuff that we've talked about. It's the time to expiry, is the current time, is the implied call, is right. The only thing that's a little bit extra is this cumulative standard distribution.
Yeah. Sorry, which distribution?
The standard cumulative
standard cumulative normal. Okay. I think I saw this formula somewhere. I read about the options, and it was just given as is. That's the formula. Don't ask why it is like that, but now it's getting clear. Yeah, and it's really not very complicated, I think.
Yeah.
If you remember what differential
question. The bottom line is that this. What are the basic ingredients? Is that these funky formulas, they satisfy this final condition of the hockey stick payout, and 2, they satisfy a partial differential equation which comes from requiring that they are functions of the stock price but not independently stochastic functions in any other way other than their dependence from their dependence on the underlying stock price.
So do these assumptions hold true in reality?
So, a lot of let me go back here, if you look at these model assumptions, you know, they're not all true, but approximately, you know, it's close enough. So what you will observe is if you try, and if you go and want to trade options, and you're going to try to, I started doing that, right? And I was looking at these prices of options on the broker screens, and I was trying to tie it out to my own pricing, and I was going mad trying to do that. You know, so the basic behavior, yes, it's the same. You're not going to get it to the last decimal, and you're not going to, because option prices are determined by a real market with different supplies and demands and liquidity and so on. And so all these assumptions here in number one, model assumptions, just don't quite hold and affect option prices to a certain extent. But the basic construct is very similar. It works pretty closely enough that you can derive a lot of intuition in order to trade from these instruments.
So, Peter, once again, in simple words, in layman terms, so stock price is defined on the market, right? But you have a model, you just presented the model that approximates it pretty well, right? And thus you can,
right. Exactly.
and thus you having this model, you can predict the stock pricing and make some money out of that.
Right. So, you know, there are a lot of limitations. This is good as a framework to have very clearly in your head. And then on this slide, I'm going to get to it now. To have this framework in your head to understand, you know, if stock prices go up or down, if volatility goes up or down, if things happen in the market, what's going to happen with your options in the future? Is this option going to be a good hedge to this other position? And so on. But you're not going to have, and you have events in the market which are just gapping out of underlying prices, which are certainly not a geometric Brownian motion. And so, you know, there you will
black swans,
break this strict mathematical assumption.
Black swans, white swans.
Yeah. Oh, not even black swans. I mean, you have it on a you know, on a very regular basis, daily or weekly, that some stocks are just gap up or gap down.
Okay.
Right. So what you have here, and now you see, if you start plotting these, in particular, with I'm plotting here a number of graphs with different time to expiry. And what you see is now something that looks very intuitive and elegant, which is that with 4, 3, 2, 1 month to expiries, the price is now this smooth curve that, as time passes, starts folding into your final hockey stick payout. Right? And at any point in time, if I'm looking at the value for a given stock price, and I'm looking at the value of the option at that point, right? The value of the option is always defined as the sum of two terms, what you call intrinsic value and time value. Remember, we spoke about time value before. Right?
Yeah.
So intrinsic value is the value with the passage of time, is the value to which your option price will converge if nothing else happens, if the stock price doesn't move. So the stock price with time just decays away. The time value evaporates. The intrinsic value stays there. The intrinsic value is rock solid. That's your final payout. Right? So so option value is always intrinsic value plus time value. And you will see that time value, because it decays to zero, it almost trades as a separate asset class from intrinsic value or the option or the underlying itself. The intrinsic value is like a delta 1 position, right?
Yeah.
It's a delta 1 position that has a jump between 0 and 1, depending on the underlying price. But time value is this thing that is being evaporated or created all the time with the passage of time and with stocks moving, right? So if you're short an option, you are long time value. You make money as time passes. If you're long the option, then you're short time value, and you lose money as time passes.
Yeah.
So, yeah.
And what is it called? This separate? You said it's traded separately.
It's not to be sure, it's not traded separately, but in your mind,
Okay.
it's good to keep in mind, to keep this distinction in mind, that a value you have in an option, there is an intrinsic value and there's a certain amount of decay. And that time value, because it's ephemeral, for lack of a better word, it trades in with a different dynamics. Okay? So now we go to the risk. And this is what formerly referred to as the Greeks. The Greeks, because they're all, those mathematicians who dreamed this up, and then they gave names of Greek letters to it.
Okay.
So you actually have, because you have analytic formulas for the price of the call and the put, you also have analytic formulas for the different risks. A risk is nothing in mathematical terms. A risk is a derivative of a value. So the derivative with respect, and that's how much the value of the option changes with movements in stock, with movements in volatility, with movements in time, or with movements in interest rates. Okay, so now I've highlighted here the two most, in darker red, the two most important risks you're dealing with when you're trading in options is delta and theta. And it has these formulas, and then you can, in fact, I have a plot of this later on. But when you're long a European call option, you are long delta, short theta, long gamma, and long vega. So vega is the risk, is how the option value changes with changes in implied volatility. Gamma is how your delta changes. So it's a second derivative. It's a convexity term. It's how your delta changes with changes in the underlying stock. And delta and theta are the more important risks for you to quantify, measure, and manage. Not that vega and gamma are irrelevant. There are specific types of trading strategies where in fact you only isolate gamma and vega and you just trade that, and you neutralize delta and theta to a large extent. But your primary risks are delta and your time decay. Okay.
Time decay is theta. Okay.
Theta, yeah. So here's a call option though. Let's go back to, let's take this orange line here, right? And you see that as the stock price goes low to the left, the tangent to that curve is nothing but the delta. Right? And so here the delta, because the tangent is approaching a horizontal line, this delta tends to zero. And as the stock grows, it approaches, it asymptotes to this S minus K line, and that has a delta of 1. And so your delta is this profile here on the left. It starts off at 0. When you're at the money, it's about 50, a little over 50%. So at 178, which is the Google stock price, it's pretty close to 50. And if you go very high, then it becomes 1. So that's your delta profile.
Okay, delta again is derivative by the stock price, the line stock price.
Yes.
Okay.
Yes, that's delta as a function of the stock price, which means that in a call option, as the stock price, remember, if you just hold the stock, as the stock price rises, you are holding 1 share of the stock, and you're still holding 1 share of the stock. With an option, if the stock price rises, your holding of the underlying stock, your effective holding, rises. So let's say your delta is, your full delta is 100 shares. If you have an at the money option, then your delta is about 50%. And so you have an equivalent of 50 shares. That's
Oh,
this
okay.
equivalent hedging portfolio that I went through in the derivation of Black-Scholes, right?
Mm-hmm.
So at the money, you have effectively, it's as if you had 50 shares. If we are sitting next to each other trading, and I'm trading a call option and you're trading 50 shares, we kind of have the same instantaneous risk. Now the stock goes up. You still have the 50 shares, but I automatically acquired now an extra, let's say 20 shares, and now my delta is 0.7. And so I have 70 shares. And so that's what this graph on the left here means, is that as the stock price goes up, I have a bigger position. As the stock price goes down, I have a smaller position. And that's for a call option. So for the put option, you can do the equivalent thing.
Okay.
Likewise, if I look now, let's look at time value, right? And what here? And if I look, time value is nothing but the distance here in this case between the orange line
Mm-hmm.
and the intrinsic line. You can see that it achieves its maximum around the at the money point, right? The
Okay.
178. Because as you go down, the time value is smaller and smaller. And as you
Yeah.
go up, the time value is smaller and smaller because the curve is approaching the asymptote.
Yeah.
And so you see that the time value starts very small. As the stock price goes up, it goes up. And as the stock price continues to go up, it goes down. And that's this curve here on the top. Okay, so that's just the amount of time value inside the stock price. It got a little cusp here just because of Excel wasn't granular enough. It's not a cusp. It's a hump.
Okay.
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 And if I look at this value with respect to time, so how this value changes in time, that's theta. So that's the derivative of the time value with respect to time. And that's the graph on the bottom. And so for a long option, you see that for very low stock prices, my theta is almost zero. When I'm at the money, my theta is the most negative because you see that it has to, at the expiry of the option, it has to lose all this value. Whereas on the left-hand side, there is not very much time value left to lose in, let's say, 6 months of the option. At the middle of it, you have this whole amount to lose. And so obviously your theta must be much more negative. So if you're holding an out of the money option, you have a little bit of time value to lose in 6 months. If you're holding an at the money option, you have a big amount of time value to lose. And so the amount per day, which is your theta, is much more negative. And if you go higher, then you have, again, less time value to lose. Okay? So that then gives you a feel for the two main risks in trading in trading options. Now, obviously, these are very simple exercises. They're just graphs for one call option, and normally you're trading a whole portfolio of them. You may have 20 different names in which you have different options on these names, and so your payout profiles can fluctuate a lot.
Yeah.
And depending on what positions you have, right? So, but I'm getting to the last slide now, and this is now we just dropped the math, and it's just some general thoughts on putting it into practice, and this concept that I mean, it sounds too informal, but it's an important concept. This is a concept that you're on your own. When you work in a bank, you're told you have to keep within this position. You cannot invest more than this. You cannot take positions in this. You're given all sorts of boundaries to play within. When you're trading for yourself, you're on your own. And what this means is more than understanding. So first you have to understand the risk, and that's understanding all these graphs and how they behave when different things happen. But more than that, there's something that there isn't a textbook for, that there isn't a unique answer for, which is, what is your own risk tolerance, right? And, you know, certainly if I tell you, look, would you risk your entire wealth on a bet that has 50-50 chance of doubling it or losing all your wealth? You probably wouldn't do it, right? So that's a very, very basic understanding of your risk appetite. Questions like that, and how much tolerance you have for losing money, how much tolerance you have for taking positions which could lose money, haven't lost money, but could lose money. These questions are questions which, when you're trading, you have to learn about yourself. And it's not in the textbook, because there are no textbooks about you.
So you cannot add it to the model, like I have this wealth and I ready to lose half. Yeah. So you have to learn it from, you have to learn it empirically.
And I will tell you even more from my personal experience. It's not, I can sit for days on end and think, yeah, I like this risk. No, I don't like this risk. Well, if it's more than this much, then I wouldn't take it. If it's less than this, the truth is, you don't know. You don't know until you actually suffer something.
Okay. And that's a must. Yes, must have suffer once or twice.
So my recommendations here at this last slide is, first, start small, experience gains and losses, but really experience them. Having the losses sounds very frustrating, but you have to have it, because you learn something about yourself, and you learn for the next time what sizes of risk you are able to tolerate or not, right? So understand your tolerance for losses. Define risk limits in very objective ways. It's, it's a maximum delta that you can take. It's a maximum theta that you can take. It's a maximum gap risk that you can take. Define it in objective terms, because there's a huge tendency when you start losing money because of a position that's exposed, you always say, let me hold on to it another day because it may come back. And when it doesn't come back, if you keep saying that and it doesn't come back, you can really lose your shirt. And so you have to have an external force that tells you, I've reached my red alarm limit. I need to cut this position, right? Then there are many, many, many different combinations of options which serve all sorts of different purposes. So I've listed some here, which are just the basic ones: the strangles, call spreads, put spreads, covered calls, naked puts, calendar spreads, and so on. Get a feel for the market dynamics. The market generally functions with three types of forces: short-term, medium-term, and long-term. Long-term is the fundamentals, as you study a company and you say this is a solid company with robust growth and revenues and so on. That's the fundamentals. Medium-term is the technicals. This stock has been on a trend and it's about to break through this trend and so on. That's the technicals. And short-term is sentiment. Is, some geopolitical event has happened, or the chairman of the Fed has issued some statement about inflation or something, and that affects market sentiment. And that's the very short term. That's the immediate, what's going to happen with the market today. Right? And then the last thing is, and this is just, it's a little bit how I operate. I have to say, I know people who don't operate like this, but my recommendation certainly is keep excruciating detail of everything you do, because you'll end up after a year having done 500, 600 trades, and you won't remember. When I did this, did it work? When I did this other thing, why did it go bad? Or what can I do to repeat the things I did when I made money? So I would say, even be as detailed as keeping track of the P&L on trades that you've terminated. to say, was it a good decision to terminate that trade?
Mhm.
So keep a sort of a
So what is MIS?
MIS, Management Information Systems.
Okay.
It's just reporting. You know, keep a detailed track of every single trade you've done with all what was happening around and what was the underlying price, and so that you can go back and say, that is how my thought evolved. Why I did this trade, I terminated this trade, I put this other trade on. This worked well, this did not work well, and so on. So keep very, very detailed reporting, because that's what in the future is going to determine if you can, how much you can learn from both the good things and the bad things that you've done. And that was my last slide.
Cool. Thank you very much. We still have 8 people with us. Guys, if you have questions, please, last chance to ask Peter. Any questions on trading? What is the most important, again from Andrew, what is the most important lesson that you learned in Deutsche Bank regarding trading strategies?
Oh boy, don't get me started. What is the most important lesson? Look, regarding trading strategies, I mean, I can give a broader answer, which is maybe more interesting than just regarding trading strategies, but is that when you're working in a bank, which is an institution which is so complex with so many different internal and external agents, all the maths that you bring to it, all the technical knowledge is at best 50%, maybe less than the skills you need to do well. There is so much about the human interaction that takes place. And there's the good stuff and the bad stuff. There's the politics, there is the learning process, there is who you network with. That is something that, again, is not in a textbook, and you have to sort of adapt as you go along. So it's, I realize it's a broader answer than just with regards to trading strategies, but just to say that by coming in with, you know, genius technical knowledge is no guarantee at all that you're going to do well.
Fair enough. Okay, cool. And again, Seth, Andrew, what's your favorite RB or momentum? Probably some stock names. RB or momentum, Peter? Can you choose?
Sorry,
Do you
I
trade
don't
them?
understand. What does that mean?
I assume Airbnb or momentum, probably some stock names. Arbitrage. What's your favorite, arbitrage or momentum? If that makes sense to you. Arbitrage.
You know, arbitrage is really, it's really difficult to come by. I mean, you may, on a spurious basis, once in a while see, you know, this thing is trading too cheap, I better buy it. But I have to say, I don't come across it often enough to say I have this favorite one that every now and then it comes up and I just dive on it. I can't really say that it's, you know, that it happens often enough, and maybe that's just related to the fact of the universe in which I operate. So I can't really say. I'm sure there will be other people who work in particular corners of the market with specific instruments and so on, that will see arbitrages that they can exploit. But unfortunately, it doesn't happen that often for me. It's very fortuitous.
Okay. And a comment from Andrew that it's sad grown up things to hear to the younger tech mind. So about Deutsche Bank and the
what?
lessons. So he's trying to say that it's sad to hear what you just said about Deutsche Bank and generally corporate culture for a younger tech mind. So the illusion
Yeah.
probably they have that if you are technically savvy, that you can do a lot in corporate world.
Well,
No.
that's not to say. I mean, I don't want to sound too pessimistic. Obviously, coming into a bank with a very strong technical background is definitely a huge plus. I don't mean to discourage anybody. I think, to me, it was sort of my ticket to come from academia into the banking world. It wouldn't have happened were it not for that I could, talk about Black-Scholes and things like that. But all I meant to say is, not to have too negative a spin on it, is that it's just an environment where there's so many things at play. The interpersonal dynamics is so important that it can overshadow just a purely technical knowledge.
And you could hardly model it with any equation.
Very hard to model.
Yeah. Okay.
If you're
And
trying to model it, you're doing the wrong thing.
yeah.
Too technical.
All right. Okay, Peter. And the last question, probably from me. It's almost 9 p.m. in Kiev. So from this model to some portfolio management, what's the way from this model that you just described to portfolio management system? Is it possible to write a script given inputs from the market and your risk tolerance level, and here's the fully automated trading system?
Yeah, I would say you should probably grow organically. So I think there's this part that I'm referring to here in this last slide, which is understanding the risks and understanding your relationship to risk is something that you're not going to automate. You have to go through that. Now, other than that, there's a lot of AI that you can put to good use for that, right? I mean, let's not say AI specifically, but just like machine learning.
Yeah.
I am sure, and this is not a new thing, right? You have hedge funds who operate almost exclusively on this basis of putting in a huge amount of
data,
of inputs, and running through neural networks that give you some predicted values. I haven't done it, but I'm sure that there's a whole world to be explored there.
But do you know if they make money with that at the end?
So, the most successful hedge fund in the history of finance is a company called Renaissance Technologies, and they function. In fact, the guy who founded it was a guy called Jim Simons, and he was a famous mathematician in his own right, and he left academia to do this. And these guys have returns which leave Warren Buffett in the dust.
Okay.
So these guys have cumulative annual returns, compound annual returns of around 65% per annum, 65% per annum since 1984.
Impressive. Yeah.
I mean, that's
But you have to be genius mathematician to do that, and make a lot of investment, I assume, into development and research.
Yeah, and these guys are so they're definitely a force to be reckoned with.
Yep.
But there are other ones. There are other funds that do that.
Interesting. And just again, a thought that I have: the sentiment analysis. Yes, it's definitely a well-known topic, well-developed topic in LLMs in particular. So there
Right.
must be system. There must be a system that reads all the news, has the news feed,
Absolutely.
and
I
then
am
and then
sure
predicts
that there are
predicts.
people
Yeah.
doing this. Yeah, I mean, I don't particularly have the wherewithal, the knowledge to put that to work, the patience for that matter. But that's I'm sure that there are people doing that. You know
But
how many times the different words are appearing in the news, determining
yep,
what you
it's
invest.
it's not actually the words. It's not the keywords. It's the whole sentence. So, if you read about modern large language models like ChatGPT,
Yeah.
they understand. We had a discussion here in Key with you about LLMs. They understand the whole context. They understand the text in some sense, and they have some
Yeah.
intrinsic
Yeah.
sense. So it's not just finding the keywords. Okay, if Peter, if we have 5 more minutes, there is another question.
Sure.
From Maxim. Hello, appreciate your effort to share underlying math in option contracts. Could you define in brief how big in percent should be move of stocks or index to give profit bigger than you lose on premium?
Sorry, I missed the first part.
Let me copy the text to you and just put it to Zoom, and you read it. Maybe it will be better. Can you see the text?
Hang on 1 second.
And it's in Zoom chat.
I'm trying to get back to the screen. I just see my presentation in a second. I'm going to stop sharing the screen.
Yeah, if you switch to Zoom.
Now I can go to the chat.
Yeah.
Hang on a second. Okay. Yes. So, yeah, how big is the percentage of a move in stock to give you a profit than you lose on premium? Well, I mean, if you define the premium as a percent of the stock price, then in this, like the case we were looking at, right? We said a 1 year option on the S&P was, let's say, 11%. Then that's your answer, right? So you will, if the stock moves up by 11%, you're breaking even. Let me see here the rest of the message. I'm going to say you lose on premium, other fees that bring in if you hedge stock bet options, wins. Yes, I think that's referring to the same thing.
Yeah, yes. There's a comment.
If I buy a call option and it costs 11% of the underlying, then the underlying needs to go up by 11% for me to break even. Anything less than that, and I will net lose.
Okay, hope that answers your question, Maxim. Okay, Peter, is market a zero-sum game?
No.
No.
Market is definitely not
a zero-sum game.
All you have to do is look at the market today.
No.
So you can, I mean, today the market was, until the time we started this presentation, the market was disastrous.
Mm-hmm.
And so this is an interesting dynamics that happens in the market. But you may say, well, the market is where, let's say the market is you and me. That's just the two of us in the market, right? And you want to buy you want to buy an object from me, and you say, well, the market is the price at which we trade. The thing is that it doesn't work like that. So what really happens is that because of sentiment, because of different pieces of news coming out, the market can move without a single transaction taking place.
Really?
So in what sense would it be a zero-sum game? If the stock price of Google now is 178, and I sell you one share of Google for 180, then I made $2 and you lost $2. So in that sense, it's a zero-sum game. Where it's not a zero-sum game is if I'm just holding one share of Google and some news just came out that the Department of Justice is looking to force Google to sell Chrome which they are doing.
Yeah.
Right. And then the stock price goes down to 170. And then I've lost $8 without anybody else making these $8. I just lost it. So
you lost in P&L,
value,
but not in reality until you sell the stock, right?
I know, but you have to have a measure of what your wealth is
Okay.
without selling everything, right? You're not going out to the street
Yeah.
and selling everything you own every day to measure your wealth.
Okay.
You have to have a way, a mechanism to measure your
Mhm.
wealth. The way you do it is you look at the price in the market.
Okay.
And the price in the market is moving up and down with the news that are coming out and the sentiment. And so, people can make and lose money without any single transaction taking place. And on a net basis, a lot of people losing money, a lot of people making money. Today, a lot of people lost money because the value of the stock market as a whole went down.
Mhm. Okay. Thank you.
Okay.
Okay, 2 hours exactly.
All right.
We had a talk, very nice talk. Thanks a lot. Very interesting. Hope it will be useful for guys. Obviously, we have some interest from the audience. You see, guys probably try to trade themselves, and the mathematics, quite inspiring. Yeah, it's not, to me, it's like linear sum, buy and sell, just arithmetic. But no, there are depths and depths of mathematics in the underlying model. Okay, thank you very much, Peter.
All right. You're very welcome.
Yeah,
It's a
yeah.
pleasure to be here.
Have a nice evening.
All right.
Yeah, and bye-bye.
Thank you. Bye.